Good afternoon, Home Encounter. Just wanted to send you a video. We always told you that we would be the first to let you know when we felt like there was some recovery afoot in the housing market. And I wanted to share some news that's being picked up by several of the stations tonight and played around dinner time, but I want you to be the first to know it. Our trends through home sales stats are showing that we have entered a period of 6 months of home price recovery. And for us, that we believe is somewhat of a trend. So although it's very hard for us to look and say we've reached the bottom of the market and we're now in a recovery mode, I think there are some signs that could suggest that's exactly where we are. So let me show you what we're looking at right here. You're looking at median sold prices in all of the seven Tampa Bay counties over the last year and a half. So look what happened here in January of 2010. Prices started to climb, and that was in response, if you recall, to the home buyer tax credit. And the home buyer tax credit ended in June. And after June, look at how prices fell precipitously all through the year, a little uptick in December, and then boom, down to $100,000 by January. So from June of 2010 to January of 2011, there was about a 30% drop in home prices. But January 2010 marked a turning point of sorts, because in February prices didn't decline again. And in March they jumped considerably, 10%. And they have climbed every month since. Now we're in a 6 month of straight declines. And from January, our home prices are now up 22% to a median home price of $122,000. Now, you all know that economists don't usually look at month-over-month prices to determine trends. They want to see year over year. How have prices trended year over year? Well, so that we don't appear bourgeois, we'll do the exact same thing and scroll down here. And yes, the disappointing reality is that sold prices year over year are not quite as good. They're actually down about 6.2%, 130,000 in June of 2010 to 122,000 in June 2011. But keep in mind what I said earlier. June 2010 represented the last month of the home buyer tax credit. Everything was artificially high back then. The extra demand, as driven by the home buyer tax credit, had forced prices up to a level that could not be sustained. So when we look at a year-over-year trend, of course we're going to be down from a year earlier, given that a year earlier was much higher than it should have been thanks to the government. Now here's what's driving this price increase. Look what happened with foreclosure starting in June of 2010. Look how they started to climb and climb and climb and climb and climb, and they were a huge portion of the market. I mean, back in March, they peaked to a point where foreclosures and short sales combined represented about 55% of the market. And as you know, foreclosures sell at about half the price of conventional sales. So when we had such a huge portion of the market in distress, then naturally median prices were very low. Well, look what happened here. Boom, we had this huge drop off in foreclosure sales. Actually, about a 50% decline in the total number of foreclosure sales occurred from March to June. So June's numbers were half of what they were in March. Naturally, that puts less downward pressure on the median price of home sales in the area, meaning home sales prices can be buoyed by these fairly stable conventional sales and these increasing number of short sales. Given that we have all of that activity going on, what we've been able to see over the last really 6 months is just a less of a downward pull by foreclosures, and prices have been allowed to rise like they haven't been allowed to do for a long, long time. Now, here's why we're not yet willing to firmly ring the bell of recovery. Even though prices are increasing and have increased for 6 steady months, look what's happened to the number of sales. We saw this typical seasonal adjustment in the number of sales from January through March, and then all of a sudden they hit a wall. In March, the number of sales began to fall, even as home prices began to rise steadily. So we could say that it's just a theory of economics at play. As prices go up, demand decreases. And that could certainly be the case. But what it's probably indicating is that the people who are buying up the foreclosure properties are just not substituting conventional sales now that foreclosure inventory is falling. We wish that were not the case, because if these people who are buying foreclosures jumped out of foreclosures and into short sales or conventional homes, then I think we could firmly ring the bell of recovery. But since they're not doing that, then I don't think we're quite near recovery yet. However, the promising trends in increasing prices is definitely signaling that I think we're in a trend toward recovery that may be here before too long.